Hello, this is Brian Bleising with Financial Brokerage, and today I'd like to clarify some index universal life misconceptions that I continue to hear in conversations with people all across the country, and there's really three of them out there, and I'd like just to put them out there so people know. Let me back up a bit here. If you're already dealing with index life insurance, you already know this. But if index life is something fairly new to you, you want to listen closely. So first off, an index life insurance policy is not a securities policy. You do not need a securities license to sell it. A Series 6, a Series 7, they are still filed with the states as fixed products. Which brings me to the second point. Why is that? Why are they fixed products? Well, because your client cannot lose money in these things due to a market downturn. The worst that they're going to do is get 0% for a given year. Your clients cannot lose money. That's one of the items that defines what's a security versus what is not. And same thing goes with index annuities. They are not securities products. You don't need a separate securities license to sell them. Now, another misconception is that some people might say that index products are confusing. It's a little hard to understand how the interest is being calculated. And I would argue that it's actually less confusing than a fixed interest rate. The rate calculations are actually more transparent. Now, what do I mean by that? Well, ask yourself, with a fixed interest product, a pre-declared interest rate, how does the insurance company calculate what that interest rate really is? I mean, do they spell it out anywhere? If you called and asked, would they tell you exactly how they arrived at that number? I mean, we really don't know. I'm sure their actuaries do some calculations, but when it comes down to it, my take on it is that it goes to the board of directors and they decide, well, do we want to go with this number that the actuaries came up with, or do we want our bonuses to be a little larger? I mean, that's completely hypothetical. I have no idea, but that's the point, right? We have no idea how they really come up with that fixed interest rate. Now contrast that with an index product and you know exactly how they come up with that. The formula is spelled out in the policy. It's spelled out in the illustration. Your client can figure this out ahead of time. They don't need to wait for a statement from the company. They know what the interest rate is going to be. All they have to do is look at the S&P 500 on their policy anniversary, look at it a year later, use a calculator and some simple math and figure out what the increase has been, if there was an increase, and look at what their cap is, and they know what interest they're going to get on their money. So to recap, these misconceptions on index products, they're not securities. You don't need a securities license to sell them. Your clients cannot lose money due to a market downturn, and the interest rates are not all that confusing. You have a simple formula, it is very transparent. A fifth grader can figure out what the interest rate is going to be. If you happen to have questions, call me, let me know.